Hello and welcome to the first edition of Market Insight, and Happy New Year to all the viewers from everyone here at Progeny Asset Management. In today's session, we're going to be taking a look at 2025 and some of the key events and what really drove markets. Today, I'm joined by Robert Harrison, Head of Smart Beta and ESG, and I'm Craig Melling, Director of Investments. So when we think of 2025, it was a volatile year, but actually a year which was good for market returns. It's been dubbed the everything rally. In today's session, we're going to be looking at some real key events, and we've put some on screen here. It was a busy year, Rob, with lots going on.
A very busy year, very volatile year, but a very positive year for markets.
And when we think about some of the things that have happened, let's look at some of the key events. DeepSeek, Trump tariff, Liberation Day, central bank policy. Investors did have a lot to navigate, didn't they?
There's a huge amount to navigate, and as we can see on screen, the number of events over the year was huge. The biggest event was the Trump tariffs in April, Liberation Day, where Donald Trump came out with a huge amount of tariffs, which put tariffs back 100 years. What we saw was a big market drawdown across the globe with a lot of uncertainty of what's going to happen. The big concerns were what could it do to inflation and what could it do to company profits. Throughout the year, though, the market rose following these events because we didn't see a big impact on company earnings. We didn't see this rise of inflation that people expected. Trump really went back on a lot of tariffs, and yes, they are higher than they were at the start of 2025, but compared to the Liberation Day, they were much, much lower.
I think it's a really interesting point, isn't it? Because we hear a lot around markets of being disconnected or they've not been focused on the geopolitical events. And actually, what reality is that stock markets shouldn't really do that. Stock markets should be focused on company earnings, the solvency of companies, and what the macroeconomic outlook looks like for said businesses. So the market actually last year just really focused on fundamentals of businesses, cash flows. Lots were talking about AI and the AI boom, and I'm sure throughout this podcast and many this year we're going to be talking about AI bubbles. But last year was a real focus on company earnings and how those earnings were broadening out across different sectors and different countries.
And I think that's key. And what we saw is across sectors and countries, earnings were strong. The economy stayed strong. There was no recessions. And having the strong economic backdrop and the strong company earnings meant most asset classes did extremely well.
And as we take a look at stock market returns, we've got a few stats, haven't we, Rob? I think for the first time since 2009, the UK was the best performing, one of the best performing stock markets. Stock markets globally rose in tandem for the first time since COVID.
Yeah, and I think that's key. So it's the first year we've seen every asset class rise over the year since COVID.
And one of the key things we talked about at the end of 2024 is US exceptionalism. And I think, interestingly, the US didn't necessarily drive returns, or it wasn't certainly top of the league last year, was it? Do you want to talk about some of the markets which did better than the US, and why is it that the US lagged some of those returns?
Yeah, I think it's a really interesting point. We saw the US was actually the worst performing major indice last year, which is the first time that's happened in 20 years. And we've had this period of US exceptionalism. But I think if we bring it back 1 point, the US still did very strong returns. We saw high double-digit growth in the US. So it wasn't like the US fell or had a bad year. It's just other markets had started to catch up from previous years.
And I think that's key, isn't it? We've been talking about broadening of returns for a long time now. I think you alluded to it at the beginning. Trump tariffs, they retreated 15 to 20% off some global markets in a handful of days back in April. But actually what we saw was that rebuilding of wealth, rebuilding of the stock market, but actually investors repatriating monies to different areas of markets we've not necessarily seen for the last couple of years, looking at valuations, looking at company earnings, and just looking, I suppose, where the value for money per se was outside of the US.
Yeah, and that's what we can see from the data, that emerging markets in local currencies were the best performing markets. It was very split within there. China had a brilliant year, India not so much. But if we went back to 2024, that was reverse. So we're starting to see some of these markets that have lagged, UK also being one, starting to catch up. It really was a year of most indices hit record highs.
Yeah. And I think one of the things, if we drill into kind of why is that, I think we'll come on to currency in a second, but certainly from Liberation Day, that uncertainty Trump brought around the US economy and probably the global economy and the impacts that would have on inflation, that really led investors to looking at probably the macroeconomic backdrop. It got investors really kind of focusing on what central banks are going to say, and central bank rhetoric changed throughout the year, and it was one of the big positive drivers for the end of the year as we saw central banks starting to cut interest rate into a positive economic environment. But currency, let's touch on currency because it did have a big impact on how returns were felt across the investor base.
And yeah, currency was key last year. And we've not seen currency movements like this for a long time. And interestingly, a lot of it came from the US. So usually you'll have currency blowouts like the UK in Brexit or China or other political events around the world. But this time it was the US with Trump tariffs, with what was going on with the US, with foreign policy. All these elements had an effect on what the US dollar looked like. So in the UK, we saw UK appreciate 7.5% against the dollar. So if you were invested in US equities, you had lower returns as a UK investor if you had that dollar exposure.
Yeah, and to put some numbers and context on that, I think US returns in dollars was for the US market was about 17-18%. If that was translated back into sterling for a sterling investor, you're probably looking at nearly half that, 9.5%, are you? So it did have a dramatic outcome on returns for investors.
And this is a reverse of the last few years where owning the dollar over sterling has actually been a big positive for investors.
So really, if we take a look at equities, and let's just think about some key themes here. We've seen a broadening out of returns, so money leaving potentially the US and moving into other asset classes. That was for a number of reasons. Valuations across other markets looked good value. We've seen positive economic announcements, in particular from Europe, where we've seen a spending bill which is 180 billion euros, and that had a wide-ranging effect across the European markets and led Europe to do quite well in Q2, Q3 of last year. We've seen a change of government in Japan, which was positively welcomed, and the Japanese market had a strong outcome. And you've already alluded to, Rob, we saw the emerging markets have a positive year on the back of 2024, which was a disappointing year for them. So equity markets strong throughout. Let's take a look at kind of fixed interest and bonds. Fixed interest, again, had a positive year. It was a little bit more volatile. Central bank rhetoric, certainly things that were happening here in the UK around the budget, left central bank policy and investors worried about what could happen with interest rates. But actually, overall, obviously, the old adage, it's better to travel than arrive. It was still a positive year, wasn't it, for bonds?
Yeah, it was really positive for both government and corporate bonds. We saw interest rates come down across the globe, apart from Japan. But yeah, it's a really positive year for bonds. But the rhetoric throughout the year changed. Every few months, economic data was coming out. Sometimes it looked more positive, sometimes it looked more negative. And again, the rhetoric around what rates were going to do did change. We saw broadly what we're expecting in rate cuts in 2025. Going forward, the direction of travel is still for rates to come down further. And this is really off the back of inflation's come down. So there is still inflation in the system, but it's not like inflation we saw in 2022. And there's signs that it's coming down a bit more, which has given central banks the wiggle room to start stimulating the economy more.
I think that's it. I think a lot of eyes, and we talked about this in the last couple of sessions, all eyes will be on central banks. What is expected? Are we expecting to see further cuts or more stabilisation? We just don't know yet. And that's something we'll probably explore in the next session, what that outlook for 2026 is. But investors will be firmly focused on a number of themes which we had in 2025, inflation, interest rates. I suppose the new one is there going to be any prolonged impacts to the tariffs, anything we've not seen thus far? And we've not mentioned it here, Rob, but we've got to touch on it, and that's AI and the AI boom. We're not going to call it a bubble just yet. Many are, and I think we'll hear that a lot in 2026 about an AI bubble. But ultimately, we do know valuations appear to be stretched. These companies are generating phenomenal earnings. They had a bit of a pause for breath last year, but I think AI still did well last year, and that theme is going to be one of the stronger themes of 2026. Anything we want to touch on around 2025 in particular?
I think the key is, you said, the fundamentals in 2025. Companies had a great year. The economy, nothing went into recession. And I think if you look at both equity markets and bond markets, company earnings really helped. So corporate bonds outperformed government bonds because there was no defaults, or there was very few defaults in the world. And I think that's key. As long as the economy stays strong and the fundamentals keep coming through, back to your point on AI, it's all about the earnings. Valuations look expensive, but these companies all hit record earnings last year. So if they can still create the cash flow and the profits, then the valuations don't look as stretched. If the money doesn't come through and it's been a very expensive exercise, then it's going to be a different matter.
And I think there's a lot of lessons learned in 2025, or certainly things investors can take away. And we talk about it a lot. Managing emotions, staying invested and focusing on the long term, because as we saw from the chart, a lot happened in 2025. It can be and was unnerving at the time, and headlines can sometimes be negatively focused. But actually what mattered is staying invested, looking at that long-term plan, and actually pushing through the volatility we've seen. If investors had taken money out on the back of Liberation Day when emotions were high, think of the returns that they could have lost.
And I think we're going to see a lot more of this. As we see what President Trump's doing this year, there's going to be a lot more noise. There's going to be a lot more political uncertainty. How this affects stock markets and companies' earnings and the economy is unknown. But we're going to see a lot more of this noise around, and it's going through the noise and staying invested for the long term.
It is. And I think one thing that fundamentally, right now I believe in is that markets laser focused on companies. And I think, investors should be focused on that longer term, but ultimately the market is focused on that longer term now. The market is focused on how well companies are doing. Are they delivering on their earnings? And I'm not saying they're trivializing or they're shrugging off what's going on geopolitical, because that's not going to go away. I think that's obvious from the first couple of weeks of this year. But actually, it's almost sometimes blocking out some of that noise and focusing on the fundamentals of investing and what we're trying to do. And I think last year, that's probably the biggest lesson for me, is sometimes taking that step back, isn't it? And looking at what companies are saying to us. So that's been a whirlwind of a recap of 2025. Certainly, there was a lot happening. In the next session in February, we're going to be really focused on what lies ahead for 2026, the market outlook, and some of the themes to continue watching. So from me, thank you very much for listening, and we'll see you in February.